Hello beautiful people, welcome to the channel, and today we are going to talk about some of the common jargons that are used in the investing and finance world that we must all know. One of the best things that we can do for ourselves in terms of our finances is to keep learning. And by learning I mean, since most of us are not taught about money at school, we need to ensure that we are self-educating. So we need to take advantage of the resources that are available in terms of the internet, where you can find different blogs. You also have YouTube, where you have different YouTube videos that are speaking about money. You have money books. We have a whole lot of resources that we need to take advantage of so that we learn about our finances and we will be in a better position to actually manage our money. One of the hurdles that I actually experienced myself years ago when I started taking my financial education seriously was actually all the technical words that were used that I did not understand. And I really made it my mission or my priority to make sure that I read on them and I understand them so that I'm able to implement what I have learned, so that I manage my finances better and I'm able to grow my money that I put away in my savings and investment accounts. So that self-education really assisted me to get my finances in shape and to be able to take that financial journey where you are constantly improving every time. Many of us, I don't know about you guys, personally, my goal when it comes to my finances is actually financial freedom. I want to get to a point where my decisions that I make in life are not based on whether I can afford it or not. So money is not an issue when it comes to me making decisions. And for me to get there, I have to not only earn and save and invest, but I have to understand my finances, I have to understand investment. So understanding these technical jargons allow us to really be able to implement our financial plans and our financial strategies so that we can get to that financial freedom that we want so badly. That is why in today's video, we are going to cover some of those jargons, and on our list we have 40 of them. So in today's video, we are only going to cover 20 of them. So today's video is part 1, where there is a part 2 coming next, where we will look at the other 20 to make up our 40 on the list. At number 1, we have the stock exchange. The stock exchange is an institution that hosts the market where buyers and sellers of stock are able to trade with each other. And this happens at prescribed business hours. So for instance, you will find a stock exchange that opens at 9 a.m. and then it closes at 4 p.m. for instance. So between those times is when whoever wants to buy or sell their stock are able to trade with each other. Then we have a stockbroker. A stockbroker is an individual or a company that facilitates the buying and selling of stock. So me as Elizabeth, I cannot just go to a stock exchange and start trading stocks. I need a broker who will facilitate the buying and selling of my stock. So that is basically what a stockbroker is. They are the middlemen, if you must say, between the stock exchange, which is the institution, and those who are, or those investors who are buying and selling their stock. At number 3, we have a share. A share is a unit of ownership of an investment. It can be an investment into individual stocks, into a company where you buy individual stocks, or it can be in a mutual fund or whatever type of fund. So basically, it's a piece of an investment. It's a piece of ownership in an investment. Then we have equities. Equities are basically shares that the company issues to represent its ownership. So ownership of shares in a company is referred to equities. At number 5, we have a portfolio. A portfolio is a collection of investments that are owned by an individual or a company. So when you talk of your portfolio as an individual, for instance, It can be shares that you own in companies. It can be ETFs that you have equity in. It can be some cash. It can be bonds. So you have, it's like everything that you basically invest in becomes part of your portfolio. At number 6, we have asset classes. Now, asset classes are just securities that have similar features. And the most common ones you find is that you have bonds, you have cash, you have property, you have stocks. So those are the different types of asset classes, or at least the most common asset classes that you can find. At number 7, we have asset allocation. And asset allocation is basically about how you are dividing your investments into the different asset classes that are available to you. So you are choosing to say a certain percentage goes to cash, for example, another percentage goes to stock, another percent goes to mutual funds. So it's basically how do you divide your money and deciding where it goes. Now, and that is what forms up your portfolio. At number 8, we have diversification. Now, with diversification, you are basically saying you have a basket and you are dividing that basket in different portions. When you are diversifying, you are actually making sure that you are putting your investments in different places. For instance, when you decide to invest in a global market, or you decide to invest in local markets, you decide to invest in bonds versus stocks. So different investments perform differently at different times, and that allows, once you have diversified your portfolio, then you are reducing your risk. So not all your investments will be underperforming at the same time. And if you are choosing in terms of geography, when one part of the world is not doing well, then another part is doing well. So when you are diversified, you benefit from those differences. So diversification is quite important so that you are not locked in one type of asset class, and you are also not locked in one location or one industry. You are making sure that you are protecting your assets from volatility, and you are also reducing your risk. At number 9, we have dividends. And dividends are one of my favorite income sources. Dividends are a portion of a company's earnings that they pay out to their investors. I'm a big fan of dividends because you sometimes invest once in a dividend paying company or a dividend paying stock, and regardless of whether the stock has grown or not, if they pay dividends, at least you benefit from that, regardless of how the market is performing. So when it comes to dividends, it's really the company deciding, because it's not mandatory for them to pay out dividends, but it's them deciding to say, look, let's pay out this portion of our earnings to our shareholders. At number 10, we have an index. An index tracks the performance of many investments. For example, an example of an index is the S&P 500, the largest 500 companies in the United States. An index that is now the S&P 500, it now tracks the performance of all those 500 largest companies in the US, how they are performing. At number 11, we have a mutual fund. Now, a mutual fund is a type of fund that allows investors to invest in an index. A mutual fund is a collection of pooled investments whereby the shares or units are managed by a portfolio manager. So it's an actively managed fund where you can invest in. When it comes to mutual funds, you don't trade throughout the day. Basically, it does not work like the way you trade stocks and ETFs. With mutual funds, the transactions are happening at the end of the business day, and it's not happening throughout your normal business hours where the stock exchange is open. At number 13, we have the exchange traded funds, which for me, they are one of my favorite, because an exchange traded fund is similar to the mutual fund. It's pooled investment also. However, the exchange traded fund, which is referred to as an ETF, it trades just like a common stock. It trades just like shares. You are able to buy and sell ETFs throughout the trading hours. Basically, you are benefiting from a pooled investment with a trade similar to individual stocks. At number 14, we have inflation. Now, with inflation, the best way to look at how inflation affects us is to look at the price of bread or to look at the price of fuel. Especially here in Namibia, the price of fuel is really high. So it's basically the increase in the prices of goods and services. And since we are trying to be investors and we want to grow our money so that we don't only save, but we are also investing, it's important to make sure that our investments are actually either on par with inflation or they are able to beat inflation. Because if we only invest in asset classes that do not beat inflation, then our money is not worth, with time, is not worth as much as it was worth before. So the value of our money becomes less. At number 15, we have interest rate. Now, interest rate is the amount that an insurer or a fund manager agrees to pay to either the bondholders or the investors in that fund. Usually it's a percentage of money that the insurer or the fund manager promises to pay the investors for the money that they invest in that fund. At number 16, we have valuation. And valuation is the value or the worth that is placed on a company by investors. So it's the price that investors assign to an individual stock. At number 17, we have appreciation. Appreciation is the increase in value of a financial asset. For example, your home, if the price goes up from what you have bought it for, then the valuation will go up. So its value has gone up. At number 18, we have the bear market. And a bear market is when you have a period where you have a prolonged period of stock prices that are declining. And usually economists and finance people look at the fact that stocks have gone down with 20% or more. Then that is the bear market. Then the opposite of the bear market at number 19 is the bull market. And the bull market is when you have prolonged periods of stock prices going up, then that is what is referred to as a bull market. At number 20, we have a recession. And we know that a recession is an economic downturn. So when, for example, when a country is in a recession, the economic activity in that country is down. Economists actually look at this when you have 2 consecutive quarters where the gross domestic product of a country keep on declining. For today, we looked at least 20 investment jargons. In the next video, we are going to look at the other 20 that are a must-know in our journey to financial independence and understanding the world of investing. I do hope that you found value in this video, and I'll see you in the next one.